Hello, everybody. Welcome to CoinFund Q&A. Today we have Scott Nelson from Sweetbridge, as well as Alex Bulkin from the CoinFund team, who's worked very closely with Sweetbridge on their crypto economics and their white paper. Welcome, guys. Thank you for joining.
Thank you for having us.
Awesome.
Thanks, Jake. Finally, I'm part of a Q&A.
Scott, do you want to introduce yourself a little bit and just give us a little high level of what the project is, and then Alex, I'll ask you a few questions about how you contributed there.
Cool.
Sure. I've spent most of my career at the confluence of three things: finance, supply chain, and technology. I've actually developed compilers and written programming languages and done analysis for an LBO firm where I worked as an analyst, and then spent a lot of time working for some of the largest corporations in the world with a prior business that I built that did settlement and audit of supply chain transactions. Sweetbridge is a really big idea. It's a big project with a very practical way to start. There's a very big part of the world that most people are kind of unaware of, which is called the supply chains of the world. And the supply chains of the world drive $54 trillion of GDP. It's 2/3 of all of GDP, which is substantially bigger than the financial services market, which is 13 trillion, to give you kind of an idea. This probably has the greatest application for the blockchain, and we're looking to create a series of protocols over multiple years that will help bring liquidity in all forms to capital, assets, and talent within supply chains. We have a very practical project, part of our project that we're releasing at the very beginning of next year, which you can kind of think of as the ability to provide yourself with banking services.
Awesome. So I'd love to dig into a little bit more detail with you there, Scott. But before we do that, so Alex, can you talk a little bit about yourself and how you work with Scott and the Sweetbridge team to help formulate this project?
Yeah, so I'm part of CoinFund, and CoinFund is an advisor to Sweetbridge, and I started working with Scott back in late July, kind of understanding the scope of these ideas and making sure to communicate them and to give them a lot of detail at the economic level to kind of verify some assumptions and and try to basically formulate the details of the product at various stages, but most importantly, in a shorter term, and how it operates in the crypto space, because sort of my expertise is to think about crypto economics and crypto in general, and how applications can lend themselves into this space.
Got it. So let's dive in. I really I think it would be worthwhile to focus a little bit on the very practical side of this, and which is sort of the lower layer protocols that Sweetbridge is working on. It also represents kind of the first parts of the system that are going to be deployed early next year. And this deals with the ability to give liquidity to certain assets that may have varying levels of liquidity, and that liquidity, I think, subsequently drives the ability of the supply chain to be a lot more efficient, and opens up access to, as Scott mentioned, something like $54 trillion worth of capital. So Scott, can you go into a little bit about how that lower layer works, and what is the functionality that users get from Sweetbridge?
Well, let me put it in context first, and I'll answer that. So,
okay.
Bitcoin represents kind of a mechanism for store of value and the transfer of payment in kind of a frictionless way. And so it proves something really important there. Ethereum added the ability to add agreements to that and transfer value and conduct payments. And we're kind of the next logical step, which our first protocol is the ability for people to basically bank themselves. So this goes beyond payment and beyond creating agreements. It goes to being able to provide loans for yourself from assets that you own that can be controlled or manipulated by by a blockchain. And this is a very it's kind of the logical extension of what Bitcoin and Ethereum have done. If people think about it very long, they'll come to the same conclusion, which is that we really don't need an intermediary of any kind anymore in that process. We can create an agreement with ourselves to basically repay ourselves for a loan that we take against an asset that we lock up on the blockchain. And for example, you could take some Bitcoin that you have or some Ether. Those will be the two key asset classes we support in our proof of concept, which will be available early next year. And you can collateralize it by putting it into a smart contract, which acts like a vault in a bank would, to kind of hold title to your asset. You continue to own it, it's yours. It just locks it and prevents you from being able to transfer it to anybody else. You can then borrow money from that vault and set up your own payment terms without any credit check, without any application that you have to go through. And as long as you pay back the loan according to the terms, which by the way, you can refinance at any time and adjust your terms, but as long as you pay it back, then you can get your digital asset back and get your Bitcoin or Ether to be returned to you.
Mm-hmm. And so presumably, like the person who's borrowing a loan, they're paying interest on that loan. Is that correct?
Yes.
And who does that interest go to?
It goes back into the network to subsidize the network to drive stability, because one of the things that we're creating in addition to hold on a second here. One of the things we're creating in addition to this vault mechanism is a stable currency. So a currency that will stay stable to a fiat currency. And this is a key attribute of our system. It's a key aspect of the future. And in order to make that work, we need to incentivize market forces to create stability within the system. And the interest that is charged goes to pay those people to do that. This is instead of borrowing the money from other people. So there's no counterparty. There's no one else.
Mm-hmm. And what kind of assets, like beyond Bitcoin, Ethereum, maybe other cryptocurrencies or digital assets, do you envision that you would be able to lock up into the system long term?
Real estate, equipment, receivables, inventory, your income stream, the kinds of things that banks would provide consumer credit for.
Mm-hmm. And when you deal with assets like real estate or kind of physical assets that a company owns, presumably there's this mechanism that when, like, if the terms of the loan aren't met, then those assets are taken and the collateral is taken and sort of sold to make back the loan. Now, in the case of Bitcoin and Ether, it's pretty easy to see that the system could just simply go to a crypto market or a decentralized exchange or something like that and liquidate those assets. But what about some of the more illiquid assets like real estate?
Sure, a car, or, say a factory or a warehouse.
Right. Yes.
In the world today of banking, there are entities or agents that basically dispose of assets for the banks. The banks typically don't do this for themselves. And we would just be tapping into them and allow them to do the same thing in many cases. In other cases, for things like inventory and whatnot, you might sell it on eBay or, Alibaba or Amazon or something.
Mm-hmm. Understood. Alex, can you talk a little bit about the digital assets that are involved in the system? There are two of them, Bridgecoin and Sweetcoin. and what are their functions and how do they interact together?
Yeah, so as Scott just mentioned, so Bridgecoin is a currency that has stability incentives behind it. And the intention for Bridgecoin is that it will serve as a stable transaction currency for various purposes, including supply chain commerce down the road, but initially for maybe buying into other crowd sales or for holding a stable crypto asset. Everybody, the crypto space needs a stable asset. Everybody understands the need for a stable asset for various risk purposes and for transaction purposes. And there have been a few different attempts to do that. I think, the Sweetbridge system is really trying to build on the experience of other stable tokens and to develop a very versatile economic system that ensures this stability through various controls, and as Scott mentioned, market makers and incentives for people to either buy or sell Bridgecoin at different times as market forces affect it. So that's Bridgecoin. Sweetcoin is a second token, and it's a membership and discount token, which basically means that as you take out loans, which is a service that Sweetbridge provides, or you participate in the exchange infrastructure, which is also provided by Sweetbridge, to convert Bridgecoin to fiat and back, holding Sweetcoin reduces the expense of you doing so. So, for example, if you're taking out a loan on some amount of Ethereum locked into your asset vault, you would typically be paying some number of percents annually, which will start at about 6% and then slowly diminish, but it will never go down to zero. If you're holding enough Sweetcoin at that time, it's possible for you to even take a loan that is completely interest-free. So the discounts that Sweetcoin will generate can go up to 100% of your fee. Additionally, the Sweetbridge is going to be providing redemption services, so there will be funds that are available for people who want to redeem Bridgecoin into USD or crypto, and of course those funds are limited, and the priority access to those funds for redemption will be given to also Sweetcoin holders. So if you hold Sweetcoin, you have an ability to take out very cheap loans or even interest-free loans, and then an ability to exchange Bridgecoin for other currencies at par at very low cost.
Mm-hmm. And so it sounds like, so you mentioned that Bridgecoin is a stable coin, and there's generally, maybe like two models, generally speaking, how those work. And one is kind of a decentralized arbitrage model, and one is an asset-backed model. Is Bridgecoin an asset-backed coin or the former?
So it is a little bit of both. So Bridgecoin will always be supported by a combination of assets locked in the vault and assets that are received by Sweetbridge when Bridgecoin is created by paying fiat. The proportion of that will be kind of observed, and when data in the system is more available, we will have to decide how much of both we can kind of have for the system to behave the best. But the idea is that when you take out Bridgecoin in a loan and then you have to repay it back at a later time, that generally means that the price of Bridgecoin, if it ever goes down in the market, then you have a huge incentive to buy it on the market, and then repay it for your loan when it is cheap. So the asset vaults provide a kind of a long-term stability control. And then at the same time, Sweetcoin holders will be able to buy and sell, so create and redeem Bridge coin in exchange for fiat and back, which means they will create a kind of a much more short-term and much more of a quick correction to the mechanism on the market, to the price shifts on the market. And so we're hoping that these two mechanisms together provide a kind of a balanced stability functionality to Bridge coin in both short and long term.
Awesome, thank you. So
it's worth mentioning on that, Jake, that really long term, as soon as we can start adding commercial activity, which will happen probably towards the end of the first year in commerce, that activity should really start to both increase liquidity and decrease instability, because in commerce, both the buyer and the seller have an incentive for the price to be the price. Mm-hmm. And the problem with market making forces is that they need instability in a market in order to make money. If you have a stock that never goes up or down, or you have a commodity that never goes up and down, you can't make any money on it. So you need to have instability in markets. And so long term, we believe that it'll be the commercial activity in the real world that will, produce the greatest amount of stability. It'll also produce an amazing amount of liquidity.
Yes, that's great to hear, especially in these markets where many of these assets trade very speculatively and sort of farther away from their I guess underlying fundamental valuations, or at least models of those valuations. So let me ask you guys, just on a very practical level. So you've built the system where a user can take an asset, lock it in, get a loan. Why would people want to do that? Like, what are some of the practical use cases of doing that?
Well, anybody who's active in the crypto space can benefit from this immediately. So a trader who's doing margin trades, for example, today on one of the exchanges is going to pay pretty decent interest rate on an annualized basis for those trades. It may not matter with the amount of money they're making, but they can hold Sweetcoin and start to use that to buy down their interest rate and actually get interest-free loans on those margin trades. You can somebody else who is looking at buying into ICOs, for example, and has Bitcoin or Ether holdings, may want to hold on to those assets, not sell them, so they can borrow from them and actually get into them. A project that has say just done an ICO and ended up with a whole bunch of crypto assets may not really want to sell those crypto assets, but they might need to pay other people for things that they're doing, employees, services that they have to buy and whatnot. Could hold on to those assets in the treasury and actually borrow from them and use the money to basically pay people. And with enough Sweetcoin, they basically don't have any interest at all. So they don't need to have any interest payments, and they could do it as a balloon payment later on. Those are a few examples.
So just to be very clear for the audience is, when you lock in an asset and when you're issuing this loan, it's not so much that you are kind of doubling your money, that now you have twice as much money that you can use to buy things. You are taking on risk, right? You do have an obligation to repay the loan. You have an obligation to repay the interest. But what the system allows you to do is to get a liquidity against this collateral that you didn't have before. So you could take that money that is now liquid, and then you can perhaps invest it. And as long as your rate of return on your investment is greater than the rate of interest, then this is actually a favorable position to be in.
And if you
also remember that the tax regime that is applied to loans is very different than the tax regime that is applied to selling cryptocurrency. So there's quite a large amount of tax savings that will occur if you can borrow to buy into crowd sales, for example, versus if you have to sell your assets to buy into crowd sales.
And imagine having a crypto asset like Bitcoin that you bought earlier this year for $1,000 and now it's worth, $11,000. Your tax basis in that's pretty high. So if you haven't held the asset for long enough to get capital gains treatment, you're going to have pretty significant tax hit if you sell it to buy into an ICO, which means that maybe you'd like to buy into the ICO, but you don't because you don't really want to take on that tax hit right now. Well, you could borrow from it at no tax and make the investment. And sure, you have some additional risk because if Bitcoin goes to nothing, then you're going to be in trouble. You'll be underwater. But if you use this as a hedging strategy to kind of diversify your portfolio without having to pay taxes, it can be very powerful.
And okay, and then so if you're in that position where you have borrowed this loan, what are sort of the tax implications of getting that loan? Like, first of all, what is the asset in which the loan is issued?
So the asset is your crypto asset, Bitcoin or Ether, for example, and you get your crypto asset for, let's say you have $10,000 worth of Bitcoin again, and you borrow $5,000 from that, based on the collateral that you have in the Bitcoin. You don't really have any tax for that. So you can now buy another asset, let's say Ether, and you buy $5,000 of Ether. You now own your $10,000 worth of Bitcoin plus $5,000 worth of Ether. And if you own enough Sweetcoin to eliminate the interest fees on that, then you can hold both of those at no cost to you. Now, if both of them go down in value, you will have increased your exposure, which is what margin traders do. But if they go up in value, you will have increased your return. And so, you can use this functionality, with the proper levels of kind of understanding what the risks are to prevent taxes and also to leverage yourself into a more protected status where you kind of diversify your holdings into a variety of different assets that you hold on to that kind of hedge some of your risk or allow you to participate in the opportunities that you think might exist in some of the other tokens or coins without actually suffering the tax consequence of selling the ones that you had such a large appreciation in already.
Got it. And so, but my question was, when this loan is issued, so if you put in, a $10,000 Bitcoin, you take out $5,000. Is that correct? The $5,000 is issued in Bridgecoin.
Correct.
Okay, and so because Bridgecoin is stable, you don't really see, like, I guess we're not tax accountants here. Let me disclaim that, but
there shouldn't be any tax consequence to that.
To getting a loan issued to you,
correct.
And because the asset is stable, like theoretically, you're not going to see appreciation that you might owe taxes on. So you can then, hypothetically go to a market where Bridgecoin trades against another asset, and then you can purchase that asset that way.
Correct. That's the idea.
Got it.
And,
cool.
And if you wanted to, you could even use that asset if it was one of the assets we support, also as additional collateral, reducing the likelihood that if there was a short-term fall in value, it was substantive of the system needing to, to sell or liquidate the asset, or you needing to add actually more assets to the system.
Awesome. Okay, so Scott, you talked about the margin trader use case where potentially margin traders can sort of lower or eliminate the fees that they would normally see on exchanges. Let's go to more of the, let's say, ICO founder use case. So someone has created a project, they've raised proceeds in digital assets such as Ether, very commonly seen there. For their project, how might they be able to use Sweetbridge in this scenario?
Well, this would actually be really good in a lot of ways for the Ether community, because what happens frequently in the space right now is people buy up some Ether and then they use it to buy into an ICO. Then the founders of the ICO need to liquidate the Ether, and what that does is that reduces the price and value of the Ether in the market. So if people could hold on to that Ether and basically get liquidity from it, there's a good argument to be made that would actually help the entire space, because you wouldn't have so many people dumping it, or it could be sold in a more rational fashion over time. The other thing is that depending on where you are, you might have a double tax hit. So you have the tax that you receive for basically selling the coin in the first place, and then you have the tax that you have to pay on any gain that you get from having held the coin in the treasury when you sell it. So you basically get to postpone that. The other benefit is that it is just creating some stability for yourself. So by leveraging it and not having to sell coin every month or something like that to get the liquidity you need to pay your bills, you provide a mechanism where you can be more thoughtful about when you do want to sell. So you don't end up having to sell when the price is down. You can sell when the price is up. And so you can kind of disaggregate when you need to sell and from when you need the cash to basically do something.
Mm-hmm. Well, and to add to that, there have been a few cases, right, when projects collected Ether at crowd sale and then sold it to cover their running expenses. Unrelated to the tax hit, you basically lose control of your Ether, and then when it does appreciate again, you basically lose that opportunity. And it creates bad incentives in this space, because people who get Ether at crowd sale then want to keep it, and don't want to spend it to fund their project.
So let me ask you, Alex. We've seen ICO proceeds behave both ways in the past. Some founders have taken a long position in their proceeds, which are denominated in Ether, and kind of made a substantial return on that. And you have other examples where the ICO proceeds deteriorated, and one example was like the Ethereum Foundation's raise, which was denominated in Bitcoin, and Bitcoin had gone, it was on that downslope from $1,200 to about $200. Now, if I'm a founder, this is a kind of a tough decision to make. It's like, do I liquidate my proceeds and then exit the market and not take on any risk? But then again, I see the market, growing, and I want to participate and I want to be aligned with it. In taking these proceeds and putting it into Sweetbridge and then getting a loan, am I not also taking on the same or greater risk if the market crashes?
Yeah, of course you're taking risk. No solution will de-risk you in case you are, participating in a highly volatile market. This is, designed for people with long views, right? And somebody who holds a long view on Bitcoin or Ether would find this to be a very useful tool. And of course, this ultimately does create an additional leverage to your kind of financial portfolio. Which means that if the crypto asset then falls, you might lose more. But let me just bring something up here that I think when you are deciding in what form you want to hold your assets, right, it's always a good idea to de-risk, and you still use your views. If you're long, you want to sell less. If you're not very long, if your views are not very bullish, then you want to sell more. But in Sweetbridge, there's multiple mechanisms, right? So for example, you can exchange Ether for Bridgecoin, and then you have a stable crypto asset. And I don't mean borrow in this case. I just mean buy Bridgecoin, and then you have a stable crypto asset, and then various components of the Sweetbridge architecture actually offer you a kind of a small return on holding Bridgecoin. You know, so it's not just that you got you know, a stable asset. You're also earning some return on it from the fees that other people pay when you borrow it. And in some sense, it gives you a kind of a lot of, you know, broad optionality about how you manage your crypto portfolio without ever really going to fiat, which is very positive for many of these organizations because they're global, and they can now start paying their you know, employees or contributors in a stable cryptocurrency, right? Which in and of itself is a very interesting proposition to many people, because, you know, people only accept Ether when it's stable, when it's, you know, appreciating. Everybody is okay with volatility, but as the space expands, you know, a lot of people are going to be using it for a stable way to hold crypto. And that's another value proposition here, is that you can basically buy Bridgecoin and then hold a stable crypto.
Cool. Can you guys talk a little bit about how the Bridgecoin stablecoin compares to other stablecoin solutions like Maker, Basecoin, you know, or Digix, for example?
So, like you said, there's many proposals in the space. I think I would like to answer this question not quite exactly the way that you meant it. And what I want to say is that unlike the existing stablecoin solutions, Sweetbridge is actually trying to create an ecosystem in which Bridgecoin will be transacted. And I think ultimately that is the only way in which you can have a stable currency, is if it has its own ecosystem. How it is stabilized when that ecosystem doesn't exist is a topic, is a kind of separate topic, and we can talk about that, and we can talk about the fact that Sweetbridge is kind of hybrid, asset-backed and you know, creation redemption stablecoin, right? But most importantly, I think we're putting effort towards creating an ecosystem where transactions would be, we're using Bridgecoin for transactions without ever going to fiat, would be a really desirable scenario. So for example, you know, the Sweetbridge application that will run, you know, first on the web and then soon on the phone, you know, actually gives you a way to transact with people safely. You know, Sweetbridge is building a set of sort of crowd sale mechanisms where Bridgecoin can be used as a currency to raise money for other projects, and that's a topic of a different Q&A. But generally speaking, there will be a very holistic and integrated way in which other people can use Sweetbridge to raise funds in a very responsible and compliant way, and Bridgecoin is kind of designed to underlie that process. You know, so I think that's what I want to emphasize is not exactly the mechanics of it, which you can read about in all the papers we published, but more of a long-term view about how do you make sure that you know, that system stabilizes by having its own economy behind it.
Mm-hmm. And that's why supply chain and commerce are so critical to what we want to do, because, you know, supply chains in the world clear more, you know, of say just the Fortune 500 would, you know, make the amount of trading that happens in Bitcoin look like nothing.
Mm-hmm. Mm-hmm.
And so you're talking about, you know, massive amounts of economic activity within the kinds of companies that, for example, my old business worked with the largest firms on earth, and you know they spend, you know, in their supply chains billions of dollars every single month, making payments. So you get that kind of activity from forces that want the price stable. They need it to be stable. And we think that in the end is the thing that produces stability more than anything else. All the other mechanisms are a combination of the projects that you've mentioned, where we tried to learn from everything everybody else has done and experimented with. But at the end of the day, we don't think that's going to actually work. It'll be real commercial activity that makes it work.
Mm-hmm. So as we head toward the end of the program here, Scott, can you talk a little bit about what you guys are going to be releasing, sort of when? So I know your token distribution event is going to be happening in short order. Sure. And what can we expect to see from Sweetbridge in sort of Q1 2018 and beyond?
Well, first, our token release mechanism is going to be different than what a lot of people are used to. It's going to be a much more secure process. It's completely KYC AML, which means you have to qualify to actually participate. And it will be a drip system where it'll be released slowly over time in tranches. So the price will go up a little bit each tranche, but it won't be the website address shows up the new Ether address, and all of a sudden everybody rushes to try to send money to it, and oh my gosh, did I get it or not? It won't be like that. It's going to be a much saner process that we think will become a standard. We hope will become a standard of excellence. But the systems that will be being released, we'll be releasing our own wallet, which will be something kind of different than the space has typically seen. It'll be a cross kind of between the Ether wallet, Ethereum wallet, and Coinbase, with kind of features from both, where you can work with a private key or you don't have to, and you can kind of move back and forth depending on how you want to work. We'll be releasing the asset vault and asset portfolio management system, which will work with Ether and Bitcoin and Sweetcoin the first quarter of next year, from which you'll be able to lock assets and get loans from it. And then from then, we have a series of other products that one of which we'll be announcing this week, which is our own crowd sale application mechanism for our ecosystem partners to be able to use. You'll also be able to use our wallet to make payments. So you'll be able to use our wallet to pay bills and expenses and things from people, and to move between fiat and crypto kind of invisibly and simply, where you just transfer the money back and forth, without thinking about it.
All right, fantastic. Well, guys, thank you very much. For anybody watching, check out sweetbridge.com for more information about the project. There's also a blog from Sweetbridge that covers a lot of great discussion around, global supply chain and even some of the formal specification of the Sweetbridge dual token system. And we look forward to following your progress in the months ahead, and wish you best of luck.
Thank you, Jay, Alex.
All right, guys. Thank you. Take care.
Thank you, Jay.
Take
care.